Good afternoon, everybody. Happy Tuesday, and welcome to this week's EcoInvestment update. Our chance to kind of mull over a few things that are going on in the economic world today. We've had a big bounce back in the oil markets, which is kind of to be expected, considering they're reducing production. At least at this point in time, it looks like Saudi Arabia, Russia, and the United States are attempting to rein in production. There's nothing like below zero oil to cause you to just stop going out in the field. But we'll see how long-lived the treaty is. We'll also see how long the recovery in prices last in the face of very slack demand. Of course, we're opening in the country now in many places, Texas. These openings are occurring in the face of a lot of rising cases of COVID-19. Chicago is breaking records every day, and it's a really tough call whether you just sacrifice the economy forever or whether you or risk it. And I think people are looking on the risk it side now, and we just don't know in the heat of summer how things are going to turn out. What we do know is we've had a heck of a rally from Dow 18,200 up to about 25,000, around in that range. A nice big rally. If you're into Fibonacci numbers, it went up to right up to about 61.8%, which is a Fibonacci number. I'm not going to get into things, but generally 30, 38 to 50, 61.8 are big retracement numbers for rallies and also for pullbacks. Let's just suffice to say it kept alive, made a lot of technicians happy when it hit that point, and then began to turn south. Turn south again. We shall see what happens. But the realities are, no matter what happens with the market, sooner or later it has to face the realities of economics and what's going on in terms of earnings. Earnings will always be the driver of stock prices. You can manipulate things in the short run, and so many of my friends that follow stocks and investments over the years are writing me, yeah, it looks like the Fed's in there, they're buying stocks, they're doing. At the end of the day, it's really not going to matter, because there's only so long that manipulation can keep a market from going to where it economically needs to go. You can have a small stream, the smallest stream in the world. You can drop a big boulder right in the middle of that stream, and yeah, for a while, people downstream will be wondering, what the heck happened to the water flow? But sooner or later, there's going to be that huge flow of water that's going to, pardon me, my allergies are bothering me. There's going to be that huge flow of water that starts to make its way around that rock no matter what you do. Well, that's kind of like the realities of markets. Pretty soon you either run out of firepower, credibility, something, or just straight funding. How much can the Fed monetize? How much can the Treasury sell in the way of trillions of dollars of bonds? Well, we'll see. They're talking about other rounds of stimulus coming up, and something, in my opinion, is definitely going to give in the weeks and months ahead. And I suspect it may be the bond market may start to finally choke on the amount of debt that's being dropped on the world right now. There's only so many dollars that aren't involved in constructive economic pursuits that are available to buy debt. And sometimes I wonder, are we coming to the end of the line where the amount of debt that needs to be rolled over continuously reaches such a point that we exhaust the surplus capital that's available in the world to absorb it? Well, it's a terrible thought. That's its own little Armageddon right there. I don't even want to go there right now. But we need to keep an eye on the bond market and what interest rates are doing. Right now, we're skittering around. We've been dropping solidly since 1980-81 here. 40 years of dropping interest rates, okay? Fed's monetizing everything in sight, but we just don't know what the absorptive power of that will be. We don't know what the impact on inflation will be. A lot of people are starting to talk about inflation. But let's keep an eye on that 10-year yield. It's around 0.6, 0.7%, 0.6, not a great return when you're lending your money on a 10-year basis. It's what does that work out? If you lend $10,000, what do you get? What, 60 bucks is $66? I can't even do the math. It's so low, like $6 a year, 50 cents a month or something in interest. Something crazy like that. Is it worth the risk? Who in the heck knows? We're all on the Titanic here. We're all floating. As far as stocks are concerned, the earnings are, they've had some great earnings, but understand that these rallies that have occurred in the NASDAQ and the Dow have been really narrowly focused on some of the big names, the Googles, the Facebooks, the Netflixes, the Amazons, the big high value babies, and a lot of the rest of the market has been lagging behind here. So we have to be very careful. In my opinion, I've now moved out. I've done all the upside trading. If the market goes to the moon, I'm not in it. Okay, I'll forgo that. But I'll tell you, my gut tells me that we're going to be going down and testing those lows of March 23rd around 18.2. And I don't want to be around to go through that kind of testing. It'll be enough to go through COVID-19 testing without having to go through that. In the meantime, the precious metals are sort of marking time as they always do. The Fed loves to keep them pushed down. I know they like to short those. It's a small market, still able to be manipulated at this point in time. But ultimately, we know that precious metals will probably be the foundation of something in the future, especially as we move towards, I hate to say it, a new world order and all of that coming up. Who wants to deal with that? Who wants to deal with that mess right now? But that's where I stand on that. I wouldn't be in a bond market, okay? Long-term bonds, I wouldn't be in it, okay? I would not be in stocks at this point in time. I'd be comfortable sitting in metals, although understand, if we downdraft again in this market, which is a distinct possibility, I can't see us going on to new all-time highs in the face of 20+% unemployment, okay? Call me crazy in my mind. Yeah, I know markets look ahead, but you must be looking ahead to 2025 or something like that to see that. I get it. But I'm just going to stand aside here and let that go on. But do understand, if the downdraft hits, it's going to take everything down with it. You're going to see the precious metals go down in the short run. You're going to see oil go through another iteration on the downside. We know the travel's impacted. We know that people are trying to get out there, but people are very wary right now. They want to make sure in the places that are open that we don't get a resurgence of the virus here. So it's a very important, it's a very trying time. In the face of all that, we don't know about mutations. We don't know. We hear rumors about scientists have discovered another mutation. We have vaccines coming from here, there, everywhere. You just don't know. There's a lot of people that are very expert at manipulating situations and taking advantage of that for their own glorification and economic benefits. You got to be careful of that too. So very perilous times that we are in. I think the market's gone ahead and priced in the very best rosy scenario for the future, but I kind of have my doubts. Well, that's the update this week. Your comments are welcome down below. Let me know down below if you think we're on the runway and off to a great future. Put that down. If you think we're going to explode going down the runway, let me know that too. Anyway, thanks for being here on this week's episode of EcoInvestment Update. And thanks so much for watching. Thumbs up are appreciated. And if you enjoyed it, please share it on your social media if you think your friends or family might benefit by a little bit of economic discussion. Thank you very much, everybody.